not every company is a fit to raise capital under Reg A+. In fact, most companies are not. Most companies that are trying to raise capital technically don't deserve it.
Hello, everyone. Welcome to another episode of Test, Optimize, and Scale. I have been looking forward to today's podcast. Have Darren Marble. Easily can say that one of the faces of regulated investment crowdfunding. I've been following Darren since his days at CrowdfundX, creation of Issuance, going into the Going Public show. I saw you speak on a panel at Expert Dojo, probably 2016, beginning of Reg CF. It seemed like you had been working in the space for years already at that point, by the way.
I'm a glutton for pain and suffering, brother. That's true.
I relate with that feeling. Yeah. But where did it all begin for you? How did you get into this space? What led you to the world of regulated investment crowdfunding?
So, first of all, it's great to be here. I'm an equal fan of yours. I think, what you do on the marketing side in this industry is just so critical. The marketing of a deal is what drives capital into a company. And I've always been a big fan of yours as well. So right back at you.
Thank you.
I guess in a nutshell, the first company I started back in 2010, so maybe 15 years ago now, was a social networking site for filmmakers. And it was my first true startup and entrepreneurial endeavor. And of course, as such, I made pretty much every mistake that founders can possibly make, starting a tech company without a tech co-founder, solving a problem that really wasn't a problem, didn't really have a monetization strategy. Nonetheless, raised maybe 250,000 from friends and family. I have a background in enterprise sales. And I didn't want my first company to be noted as a failure. And so we pivoted this effectively failed tech platform, social networking site, into a marketing agency. And what I had noticed is that creators that were raising money on Kickstarter or Indiegogo all had really clean landing pages, good stories, compelling pitch videos, really savvy, smart marketing. And I thought maybe there's an opportunity to provide comprehensive marketing services to rewards-based crowdfunders. And that was the birth of CrowdfundX. So effectively, it was the same corporation. We just totally pivoted the business from a social networking site to a marketing agency. Maybe in typical fashion, like how can we make money? Because we weren't making any money with the social networking site. And, the first client we signed was actually a hero of mine, Sean Astin from Goonies, Lord of the Rings. He's a legend. Stranger Things more recently. And I had seen that he had launched a campaign on Kickstarter. It was called Vox Populi, Voice of the People. He was going to launch his own podcast, like political talk show. And I became a backer of the project. And then I messaged him as a backer and said, hey, I'm a big fan of yours. I'm launching a business in this space. How about you let my company be your marketing engine? We won't charge you a dime. We'll do it for free in good faith. And if we deliver great services and you have a successful campaign, will you be my reference? And he said yes. And that was the first deal we did. And that led to 100 more campaigns in the rewards-based industry across games, pet food, technology, you name it, phone cases, all of it. And then several years later, we got an introduction to Paul Elio from Elio Motors.
Yes.
And he said, guys, I want to hire you to do a Reg A+ campaign. And I remember thinking, I don't know what that is. I'd never heard the term. So the client was educating me. He said, oh, it's a securities exemption. I didn't know what that was. He said, it's a new way to raise capital for startups, but we're not doling out rewards or t-shirts or signatures. We're going to issue shares. This is a securities offer. And I love the marketing work you guys have done at CrowdfundX. Will you guys run a comparable campaign for me? And so that was in May 2015. And then he became our first securities marketing client. That deal went on to raise about 17 million from over 6,000 retail investors. I had brought the deal to Start Engine at the time, and that deal put me on the map. It put my company on the map, put Start Engine on the map, and it really changed the trajectory of my career in ways that I could never imagine. Although I will say just that at the time, I knew there was something special about this deal. It was an automotive company. It was like an automotive startup, and it was a three-wheeled car, and we were going to have an opportunity to tell the story of this really cool company and market it to, millions of people. And we put everything we had into that, and it was a big success, and it was a game changer for me.
And a case study for the industry at that. I mean, any article mention of Reg A talked about Elio Motors. And
Sure.
I had studied some of the work you guys put out, some of the content around what made it successful. It was even on panels with some of your team members at the time. It put you on the map, put Reg A on the map. It
Sure.
was a big deal for the industry.
Yeah, no, it was. And, it was like a blessing and a curse. I think the blessing was we created a brand for our marketing agency out of thin air. So despite the 100 campaigns that we had run on Kickstarter in the years prior, this one deal just shot us to the top of capital markets. And so guys on Wall Street running investment banks, broker dealers, transfer agents, groups that I didn't even understand what they did, how they operated, reaching out to me, hey, how did you do that? How did you help this company raise all this capital from non-accredited retail investors? Can you do it for this deal? Can you do it for that deal? The company itself ultimately failed, right? So they raised this money. They went on to list over the counter, OTCQX maybe. And, the shares at one point, I think, doubled in price. So there was a moment in time where if you were in that Reg A offer, you could have doubled your money. But then, of course, the stock went down. They weren't able to produce cars or go into production. They needed a lot more capital. And so there, it's like there's a blessing and a curse that now that deal, there are certain people that are not fans of this industry. That was a garbage company, a junk deal. Why were you marketing this crappy company? And it was a lesson. I don't think we could have had a better client, honestly, than Elio at that moment. But lots of takeaways, lessons learned, and it catapulted kind of my involvement in this space.
And it proved digital channels, all different types of marketing could be utilized to bring high volumes of prospective investors, both accredited and retail, to these offerings. And that crowd effect could occur to substantiate relatively significant amounts of funds.
Well, absolutely. And I'll tell you where we put the emphasis in that campaign. In fact, you can still watch the video that we produced for Elio on Start Engine. And what I had learned years prior marketing successful rewards-based campaigns is that the primary sales asset is the pitch video, right? It's not the team slide or the deal terms. I mean, it's literally the 2-minute pitch video that gets the investor excited, or the backer, but now an investor. And we hired a cinematographer named Benji Bakshi, who had done some really big Hollywood films, to direct and produce the pitch video for Elio. And I remember saying to Benji, listen, I know there's something special with this campaign. That's the first of its kind offer in our industry. It's an automotive company. We have a really cool moment here to tell the story for an automotive company in the US. No one's ever heard of these guys. The car looks totally different. 2 wheels in the front, 1 in the back, et cetera. And I said, I need you to produce like the best ad campaign you've ever done, 2-minute video. And he goes, I'm in. And he said, I said to Benji, what's it going to cost me? And he goes, probably $100,000. And I said, Benji, that's our entire fee. Like, that's what we're going to get for the whole thing. I can't pay you $100,000. How about I pay you $10,000 and you do me a solid and I'll give you some of the equity we're getting in the company? And he agreed to do it. And to this day, that video then set the trajectory for where I am now in producing the Going Public series. If you look at the video, Jason, there's actually no conversation about a capital raise, a stock sale, revenues, profits. It is a pitch at the highest level of vision, mission, and values. And so that messaging worked. That actually got people excited and engaged and enthralled and emotionally attached to this company, to then have them scroll down the page, learn about the business, the investment opportunity risks, and drove $17 million into the deal at the end of the day.
from over 6,000 investors to be able to do that in that period of time for any digital campaign for that matter. That volume of conversions is quite a feat. And I like how you said, hey, the video is getting people enthralled. The page that then can do the selling from there. They could look at
Right.
additional details, have their questions answered, but they're captivated with the video, so they're primed to then hear about the offering itself.
That's correct. It's really the top of the funnel. And so that kind of moved us into equity crowdfunding, and we continued to do big deals on Start Engine primarily. And then in 2018, I decided to start my own platform. I co-founded Issuance with a CTO, brilliant technical developer, an engineer named Nick Allen in New York. And when I remember, I met Nick at a hedge fund in New York, and he says, "Why do you keep marketing these deals on Start Engine and other platforms?" I said, "Nick, I'm not a technologist. I can't build anything. I'm a marketer." He said, "I can build a better platform." And I said, "Okay, let's do it." And so that was the impetus for us to start Issuance. And ultimately, like coming full circle, we rolled up. We actually Issuance then acquired the marketing agency,
Mm-hmm.
and my original investors in FilmBreak actually got their money back, which is kind of cool. So I'm very proud of that. They didn't make 5x, 100x, but the people that put in 25K, 50K, 5 grand, 10 grand through a series of financings at Issuance that then owned the asset, I was able to return my principal capital to the investors. And one comment there, because I think founders go through this quite often, is you have a business, doesn't work. Of course, it's very hard to start a company and have it be successful. A lot of people say, yeah, wind this down, start over, get rid of your debt, clean up the cap table. I just never felt right doing that. I thought, well, these people invested in me, and I'm the person that is going to make this work, regardless of what the business is. It doesn't matter if it's social networking, rewards crowdfunding, securities marketing. I really wanted to pay homage to the people that put me on this trajectory. And I credit with my growth and being able to be in the position I am. So we actually got them their principal investment back several years later.
Huge. Not typically the case. You look at the
Oh,
success rates of startups in their first 5 years, first 10 years of business. They're not great, far from it at that,
right.
let alone being able to pay back investors, have that success event with them and be able to move on from there. And such a big fan of the fact that you were able to pivot and basically be in the listening of, hey, this is working. Actually, we're getting attention here. We're going to put our services out there for this first group because we believe in it so much. Now we've succeeded for Sean, not worried about the funds there. Over 100 deals come in, and we're doing Kickstarter reward crowdfunding campaigns right and left. We're then positioned so as Regulation A comes into effect, you're the perfect fit for Elio. You succeed there, and now all of the biggest issuers are coming to you. You then see, hey, there's a bigger play for us, and we could be of more value to these groups by operating in a fashion that allows for a more straightforward conversion rate from prospective investors. We're creating our platform, and we're now going to go to the next levels as issuance.
Yeah, that's exactly what we did. And again, in typical fashion, like it was a windy road to get here. I didn't see it coming by any means. But I think the key to success in business building is you really have to be incredibly resilient. And if you just go with the flow, you pivot, you optimize things you talk about, right?
Yep.
You can find success, and it often takes you to a destination that you really had not imagined in the beginning.
So how did the Reg A campaigns evolve for you from there? You're getting all different types of inquiries, full spectrum of different industries. You're looking for that same feeling that you had when speaking to Elio, and you're trying to find the right deals. The marketplace is changing a bit. I know in 2021, Regulation A raised 75 million instead of just 50 million. How did things move along? How did they shift? How did they grow for you?
Well, what was interesting is that we were perceived to have some type of magic wand that we were waving over these companies.
Mm-hmm.
And I realized that in a few meetings, particularly on Wall Street, where I was being flown out by the boards of investment banks or hedge funds on their dime, and they were peppering me with questions. And and on the 80th floor of some building in New York, and I remember thinking, these guys think I'm a magician. Like, this is ridiculous. Like, they actually think I know something. I have some secret sauce. And then so I really had to level set with myself. Do we actually have a secret sauce? Were we lucky? Did we get the right deal? Or do we have some secret sauce? Or do we need that secret sauce to work on the right deal? Like, these were the questions I was wondering. And then what I learned over time is that not every company is a fit to raise capital under Reg A+. In fact, most companies are not. Most companies that are trying to raise capital technically don't deserve it. And so I learned to evolve my perspective. On the positive side, we were getting tremendous inbound deal flow every day. It was coming through LinkedIn, it was coming through Twitter, it was coming through cold email, referrals from Howard Marks and Ron Miller at Start Engine. And I couldn't keep up with it. And it was a moment, it was an exciting moment. But I also realized that I needed to be discerning, because if somebody's on the other end of that line and they think I've got some secret sauce, but I think their deal is junk, or the founder has had issues, regulatory issues, compliance issues, I need to be able to say no and turn down deals.
Yeah.
And so that's what we started doing. We started turning down deals. Of course, inevitably, we took on deals that didn't work, where we were paid fees to market the campaign. And I'm sure you guys know what this pressure is like. And we had always been experimenting at the high end of the market. When we did Elio, we were paid 100,000 cash and 100,000 stock. The next deal we did, XTI Aircraft, we were paid $250,000 cash. We had a cannabis company in Colorado. We were paid $500,000 cash. And so I was really testing the upper bounds, like, how much can we sell these marketing services for? But sometimes what happens is when you're operating at like the high end of the market, it creates this pressure where the client, who may actually have those funds, and most people don't, but some entrepreneurs do, if someone's going to pay you $500,000, they're really expecting you're going to raise them $5 million.
Right. I
didn't like that feeling. I realized that it was a double-edged sword. If we were charging ultra premium fees, the client had ultra high expectations of me and my team. And if they didn't raise their desired amount of capital, they might feel misled by me or my team, even though I technically can't drive $5 million into a deal just because we run a marketing campaign, right? What if the deal has ridiculous terms? What if the valuation doesn't make sense? What if the deal structure is wonky? Again, what if the CEO has had issues? What if there's no revenue? So over time, I learned to really sharpen my senses and start working with companies I thought I'd put my own money into. These are real businesses. I'd invest my own hard-earned capital into these businesses. And so we wisened up.
I think that's so humbling of you to be able to share, hey, some of these deals work, some of them don't. That's not always the storyline that I hear from agencies, portals, any type of service provider that works with these issuers regularly. Meanwhile, when I look at the stats, if I go on a platform like Kingscrowd and see the Reg CF Regulation A+ deals to date, if I look at the 2024 analysis, the median raise amounts are not strong. I think for Reg A last year, it was 1.7 million. For Reg CF, it was 60K.
Right.
The year before, Reg CF's to date about 100, 110K. So I share that same feeling where when I'm speaking to an issuer and I'm pointing at case studies, great performance, 10x higher type results in terms of return on ad spend, they think I've never used it as magic wand, but that same type of effect. Sure. Hey, maybe he's going to be able to call some investors. Maybe he's going to be able to send out an email, but we're getting that capital. We're paying, your example, 100K, 250, 500, and getting $1 million, 5 million, what have you back. When we try to speak at length, almost working against us at times to say, hey, we can develop and distribute content, ads, we could get it to these audiences, we can get people to your deal. What happens from there is going to vary drastically at that campaign to campaign, not even issuer to issuer. I find that founders, CEOs at times will hold on to the case study metrics and forget some of those other comments and bring it back up again later. So they may hear what they want to hear. But I really appreciate how you open up there and use it as your own learnings and how you've chosen to focus on deals that you would actually want to invest in versus just take everything that comes across your desk.
Well, I think you have to, right? Especially if you want to have staying power, and especially in this industry. Raising capital is enticing. there's a mystery around it. There's an aura around it. And you're talking cold, hard cash, right? Having $1 million in your bank account, having 5 million, 20 million. I mean, we have clients now at Issuance that have raised over $100 million. And so anyone that operates in this industry has some allure. They have that aura of being a magician, especially on the portal or especially on the marketing side.
Yep.
Right? If they're going to pay marketing fees, paid media campaigns, they want to be in a show. And what I realized is that I wanted to be responsible. I wanted to be transparent. And, I think that over time, I've been able to build that reputation as I had desired years ago, which was to be able to get on a call with the company that might say, I'm ready to pay you $250,000, Darren, take my deal, and actually say, you know what, Jason, you're not a fit. I love your ambition. I love your energy. I think what you've got is really interesting, but it's not a fit for us. Here's why I think you're not a fit. And if you go down the street to the next guys, there's risk there too. And, I think that's kind of how I've wanted to brand myself, as just somebody that's honest. Doesn't mean we turn down every deal, but we've walked away from a lot for a variety of reasons over the years, so that I can have the reputation of someone that's honest and going to be truthful with the other person, the issuer, that is going to be looking at me and my team and hold me accountable, to some degree for some budget that we need to allocate to drive capital into their business.
And that's the long game. You're building a relationship with them. Maybe they come back when they're ready, when they have a larger audience, when they have a better looking deal. That big picture positioning, zooming out, seeing where things are going to be years down the line, and your own character, feeling good about what you're doing, what your team's putting time into, being able to do what you say. What do you look at when evaluating a deal? We're always asking about the audience size. We're focused, around the marketing. But what are a few things that people who are listening, people who are watching could take into account, maybe packaging their own opportunities so that they're more attractive?
I think it depends on which lens I have on, because I have two companies. I run Issuance, which is a software platform for online capital raising. And then I also produce the Going Public series, where we're looking for a handful of deals, like 3 companies in a season. We may produce 1 or 2 seasons in an entire year. So there's a different lens. I would just say, in general, at this point in my career, I look for companies that are revenue generating. I look for companies that have some semblance or strong product market fit, that they have gone from 0 to 1 on their own. They have done the heaviest lifting and proven that they can solve a problem and get paid for it, and maybe even start to show evidence of getting paid for it at scale. Of course, we love companies on the issuance side that have big customer bases, lots of customers, fans, followers, big email lists, highly engaged email lists, reservations, but you often don't get that. And so at a baseline, I'm looking for revenue generation. Doesn't have to be $10 million, but maybe 1, 2, 3 million in revenue, past product market fit. They didn't start the company yesterday. They started it 2 years ago, 4 years ago. Founder or founders have learned a thing or two about their customer. They've enhanced or optimized their product, and they're raising maybe a seed or a series A, not a pre-seed or a molecule round, as I joke, because I think VCs are in some ways are ridiculous. Like, oh, we'll call it a pre-seed round so we can get the deal flow from the seed guys, but it's the same shit. It's like, I don't really think there's a difference, just like a marketing term. So I say, well, I'm going to invest at the molecule round. Like, before you have an idea, I'm your guy. Like, I just think there's some ridiculousness there. But I like to see companies that are seed plus, right? Seed Series A businesses that have proven they have what it takes to run a company, and now they're on to the next.
And you're looking from the shoes of the investor. What are they going to be evaluating? What's it going to be like when you're actually looking at the analytics and their response rates from the offering page? You mentioned going public there. What inspired you to create this show? I've seen you speak at many conferences, all the way back to the Crowd Invest Summit, Equity Crowdfunding Week, Investment Week, the Reg A Conference. I mean, every event in the industry. What made you create your own show and your own distribution partners? I mean, you're on some large stages.
No, thanks, man. So, like, the irony of my career as a founder is that I didn't have the ideas for these businesses technically My co-founder at Issuance, Nick Allen, brought the idea for Issuance. He said, I can build a better platform than what's out there.
Right.
And my partner, Todd Goldberg, brought the vision for the Going Public series. In a nutshell, Todd had worked in medical device sales for 17 years. He had been fortunate enough to work for one such company that went public and all the way to IPO. Todd was a senior vice president in that business and had been working with the CEO on all of the capital raises up to the IPO and had helped the CEO raise about 80 million over 4 or 5 years. So Todd knew what the Series A investors paid for their shares, the Series B, Series C. And when the company went public, he went to the CEO and said, hey, I've got $1 million soft circled from my network, my friends and family that have been following my journey for 7 years. I've got $1 million ready to go. How can they get in? How can they invest in the IPO? And the CEO laughed at him and said, Todd, that's not how this works. You can't have your family invest in the IPO. The shares are reserved for institutional investors. And Todd recalls at that moment saying, that doesn't make sense to me. Something's not right. Why can't my friends and family invest in this? And so him and I had been friends for many years. Our wives used to teach at the same school in LA, and he had been following my career in capital markets. We were pioneering Reg A plus IPOs at the time to NASDAQ and the New York Stock Exchange. So he takes me to dinner at a Ruth's Chris in New York in June 2017, sits me down and he says, I've got this idea for a show like Shark Tank, where the viewers can invest in the featured companies while they watch. And the second he finished that sentence, I said, Todd, this is a dumb idea. That's literally what I said. And he was furious. He was furious. He was not having it. He's like, you haven't even let me finish. I said, I got it. I know it's a show. You just told me what it is. And he says, why are you so quick to shut me down? I said, because I've heard this pitch 20 times. I've heard it from guys on Wall Street that you don't know that want to do this show. And they got more money than you. They got more money than me. They got more connections. They've got connections to Amazon, whatever. I've seen decks for this show, Todd. I know guys in Hollywood that want to do this show. Uber drivers have pitched this idea. You're like the 10,000 person with this idea. And he said, all right, tough guy, where's the show? Where do I watch it? And I, of course, in that moment realized it did not exist. And so I started thinking through it. Why doesn't it exist? If everyone has had this idea, but the show literally is not out there. It's not on television. It's not online. It doesn't stream. And the conclusion that I quickly came to is that it's fucking complicated. Mm. And as I'm saying this out loud, Todd's like seeing me process this thought. He goes, that's why I'm coming to you. You're the guy that understands equity crowdfunding, online capital raising, Reg A+, Reg CF, technology, compliance. And I think we should do this. And so, I went from a hard no to like a soft yes in that moment. And we decided we would go out and tackle this together. And it took many years just to get it off the ground. And now, 7 years later, we've just signed a deal with X to have season 3 of Going Public stream on X in May. And we're forecasting 125, 150 million views across these episodes, which in a lot of ways is really hard to fathom. And of course, we wouldn't have had that deal with X had I really been an ass to him and be like, I'm not doing this stupid, idea. And I think the idea was the right idea. It needed execution. Mm. And it's been very, very difficult to execute. It's taken us 7 years to produce 3 seasons. We've gone through $10 million of investor capital and revenue to get here. And now I understand completely why it has never been done, because it's near impossible. And, I'm glad we stuck with it. You've got to be really stubborn and, again, resilient, to be a founder. And I'm glad that my friend pitched me that night and kind of helped me see the flaws in my own thinking, that just because it's a common idea doesn't mean it can be easily built. And glad that we decided to build it together.
Absolutely. And that grit, that resilience, that entrepreneur nerve kept you going all the way through. And 125, 150 million viewership, that's massive. What does it look like on X? So this is a viewing platform. Can we familiarize the audience a bit more of what that looks like? Because I just want to make sure that the gauge is there of how monumental this is. And
Totally.
for the industry, for entrepreneurs everywhere at that.
Yeah, it's a great question, and it's a fair question, because I think the average person that might know of X or even uses X, formerly Twitter, thinks, wait a minute, what are you going to do? Like tweet out a show, right? And so, but X has licensed 15 shows in the past several years. They've generated 500 million views across those 15 shows and generated nearly 2 billion impressions for those 15 shows. They did a show called All in the Boston Celtics, a sports documentary executive produced by Tom Brady. 6 episodes, exclusively streaming on X, generated 130 million views. A sports reality series, executive produced by Alexis Ohanian of Reddit, 180 million views across 6 episodes. So the shows stream on the platform. You're on your phone, you're on your tablet, you're on your desktop, you're logged into your X account, and it's streaming from an account. And so because X has 600 million monthly active users and they own the platform, they can serve up this content in a very real way, right? So this is not me from the Going Public account putting out an episode, DMing it to people, asking influencers to repost it, paying for advertising. This is X pushing the content out from the X marketing team to the user base in a highly targeted fashion. They now have a video tab. They just launched it a few weeks ago. Video views are up 81% year over year on X. There's an X TV app for smart TVs. And the bet we made, Jason, was that, X is the #1 news app in the United States and globally right now. Why can't they be the #1 entertainment app too? Right? Why can't they be the #1 entertainment platform? Now, they're not Netflix, they're not Amazon, but they are the biggest and most important social media company in the world from my standpoint, and I think a lot of people agree with that. It is owned by arguably the most successful entrepreneur of our time, and the pace at which X is innovating is actually insane. So the innovation from this company and this team is incredible. They just launched Grok 3. That is the #1 app in the App Store, above ChatGPT, almost out of nowhere. Grok wasn't around a few months ago. Now it's the #1, AI app. So we're betting with X here that this is a great partner for us, and it's real time. It's engagement. It's the community town square. We have a show where the viewer can click to invest and buy shares in featured companies while they watch. So if I didn't say it, that's what the show is. It's a show where we follow founders raising capital, building their businesses, and for the first time, the viewers can click to invest and buy securities in featured companies while they watch. So it's interactive, but X is also interactive because you can post something and less than a second later, 100 people have already replied. So we love that real-time conversational nature of the platform. It means that when episodes are pushed out by X and they're generating 25 million views, they're also generating thousands of comments, thousands of conversations between people talking about the series, the show, the talent, Ninja, Steve Aoki, Phil Hellmuth, right? That's the engagement and conversation that we're really excited about. And I think what makes X an ideal partner to stream the next season of this show.
I'm glad I asked. And yeah, I was thinking as you're talking about this, the X users, they're more responsive, they're more engaged than other social media platforms. You have to really get into the conversation. But I've been familiar with the shows, hearing about the video tab, hearing that people are going to have to choose between your show and Tom Brady's, hearing about some of the names that are going there, and everything you said about X's growth, I'm now more excited about it. It's also fun for me to think about because I remember at your conference at the Crowd Invest Summit, Robert Herjavec from Shark Tank speaking and him getting asked a question about this type of format. And he said, that this is our show. There's too much compliance, too much to do around that. So kind of speaking to those obstacles that you mentioned there. But You did it. And the power in the crowd, especially real time, to have social dynamics at play there and see the volume of investments and capital raised in real time while watching the show and the common boards around it. It's got tremendous potential.
Well, we couldn't be more excited. And look, I do think Shark Tank has opened the opportunity for a show like Going Public to exist. It's become a cultural zeitgeist in the United States and actually globally, of course. But it's run its course. It's an older show now.
Right.
Cuban retired. Robert Herjavec, who we brought in, we paid him fees to go speak at that Crowd Invest Summit. Him saying, "Oh, we're not going to do it. It's too much compliance issues." It's also selfishly, why does Robert Herjavec want to share the stage with a million people that can now invest alongside him? Suddenly, his shark crown isn't as big or glossy, and so. But that's what we're trying to do. We're going to disintermediate those guys. They're not needed. We don't need sharks to tell entrepreneurs good, bad, ugly, I'm in, I'm out. That game is over, right? The time for the viewer to be the shark is right now. And you don't have to cut a check for $250,000 or $1 million. You can come in for $100, $200, and you can check out, click to invest in under a minute using Apple Pay or Google Pay or USDC or Cash App or Amazon Pay. So we've made it really seamless for the viewer to become an investor. And, so like we like to clown on Shark Tank and tease, and that's part of our brand voice. Personally, I like to clown on Mark Cuban. I think he's easy to clown. Post-election, Kamala Harris, Mark, you sucker. Anyways, but, I think that this is an idea whose time has come. Yeah. I think we've got a great partner in X, and we can't wait for the world to see it.
It's why these exemptions, these vehicles were created, and you're creating a larger platform that's more interactive for it to take place. I imagine it's going to mean a lot for your deals on Issuance and the founders you speak to, and amazing to see you push through one stage to the next from each different platform and to now be on this stage. I feel like I could ask you more questions about the industry for hours here, but want to, go around the show's title a bit. Look to package some actionable insights for viewers, for listeners. You're a wealth of information here. What do you recommend for founders who are thinking about doing a Regulation A+, a Reg CF deal to test out for their strategy, if they're live, test out for their live raise itself? Where have you seen the most momentum, and what tactics can they incorporate into their activities?
Well, I think for starters, if you're thinking about a Reg A campaign, you're actually thinking wrong. You should think about a Reg CF campaign. And then instead of thinking 5 million, you should be thinking 1.2 million.
Yep.
So anyone that wants to raise capital from their customers, fans, and followers, non-accredited retail, everyday Americans, start with a $1.2 million Reg CF. That's advice number one. Why? Because it's fast, easy, cheap.
Yep.
And we talk to founders all the time that have $75 million dreams and Reg A this, Reg A that. Go prove it first. Don't waste 6 months of time and $150,000 in cash for the audit and legal work until you know you're a great fit to raise that kind of capital. And the way you know that is by knocking it out of the park on your Reg CF. Go out and raise $1 million in Reg CF, launch it in 60 days on a platform like Issuance. It's a white label solution. Then go for the 5 million, go for another 4 million, get your audit done, 2 years of audited financials. And then if you knock that out, now go file your Form 1A offering circular with the SEC and go do your 10, 20, $75 million Reg A campaign. So part of it's just simple logic is everyone has big dreams, big ambitions, especially in this industry. Most people are naive. Most people are destined to fail if they think they're going to raise $75 million. And by the way, I walk away from founders all the time that get on a call and they're like, I'm going to do a $75 million Reg A. Usually I hang up. That's a red flag. This is somebody that has no clue what they're doing, and no amount of me educating them is going to convince them. These people are delusional. Now, once in a blue moon, we get a founder that knows what they're talking about. We talked to a founder yesterday that I'm going to refer to you. And they said, Darren, we want to raise $75 million. Why didn't I hang up on them? Because they just raised $8 million on another platform. They maxed out 5 in the CF. They did another $3 million in a Reg D 506C. That's a real conversation. but you have to start small, cheap, fast, easy, cheap. Go 1 million, then 5 million, then do your Reg A. That's probably the single biggest point of advice I could give to someone thinking about running a campaign in this industry.
Well said. I'm going to quote you on that because I get those calls as well. Also, the discussions of we're going to do 5 million. Do you think we need 2 months or 3 on our Reg CF? And it's, 5 groups did that last year, actually 4.8 or higher last year, 11 the year before.
Right?
Yeah. but you can, and here's how, and here's the type of audience you need. Here's the type of traffic with average conversion rates to hit the amount of investments at an average investment amount based on the data that are going to be required. And normally at that point, I see them, take a step back and start asking more of the right questions. But what about the groups that they're going for the 1.2, 1.235? Maybe they get a few $100,000 right out of the gate, and then the campaign slows down. How do they optimize? How do you manage to a point of effectiveness? What encouragement would you have for those groups?
Well, there's a couple things, right? So one is founders need to be realistic. Not every campaign is destined to raise $1 million or destined to raise 5 million just because you raise the first 100, 200, 500. Obviously, if you're having success and momentum, you want to continue that momentum. We like to see 100% of our clients use marketing firms like DNA. If they don't have a marketing partner attached, it is by default a big red flag, right? You have to have competent marketing partners to raise lots of money. You have to. By the way, I don't care if you've got 1 million customers, 1 million emails, you've never run one of these campaigns. You need a partner like a DNA to go in and help optimize and allocate dollars to drive high ROI, return on investment, or ROAS, return on ad spend. So we'd like to have marketing partners in our clients' deals from the outset. I think there's also a variety of channels that can be tested. And I like to see companies testing 2 or 3 different channels at the same time, not 5 or 10, but certainly not 1. Maybe you want to advertise through Robinhood. Maybe you want to advertise through Morning Brew. Maybe you want to try paid influencers. And of course, have the influencers disclose compensation. Maybe you want to try to get an interview with Charles Payne on Fox Business. Maybe Jim Cramer on CNBC, right? Something like that, some kind of PR. So 2 to 3 channels outside of your traditional owned email list. You've got your email list, you've got your social accounts. What else can you be doing? 1, you need a marketing partner. 2, I like to see 2 to 3 channels and then doubling down on the things that are working and just dropping the things that are not working.
Looking at the analytics, identifying the key drivers, looking to optimize, phasing out the non-performers. Don't run too many channels, add more, look in each channel, audience, creative funnel, you're taking them down. I'm amazed by how many founders don't look at it this way and kind of shoot in the dark. And then later are wondering, why haven't I raised 1 million, 5 million, equity crowdfunding doesn't work, marketing platforms, whatever doesn't work, versus physically understanding the traffic algorithms and where it's coming from. I think those are great recommendations, and the list of channels that you listed out there as well. What about success stories? You've worked on some of the top campaigns to date. Reg A, look at the top issuers. I imagine you could just pick from those. What made them hold those spots? What allowed them to bring in 17 million more in capital? What allowed them to have a path to IPO? What recommendations would you have for founders to scale?
Well, we're very fortunate to have had some incredible clients over the years. One of the clients that we have now is an automotive startup called Aptera. And Aptera is also, like Elio, a 3-wheeled car that has a solar panel on top. So their logline or tagline is powered by the sun. Aptera has raised over $100 million on issuance over the past 2.5 years. They've raised 5 million in a Reg CF, 75 million in a Reg A+, 20 million in Reg D 506C from accredited investors. And they're master marketers, right? They're constantly investing in marketing. They're constantly optimizing. They're a very sophisticated issuer. They're constantly opening and closing campaigns. So they have the $1.50 round. It opens, it closes, then the $1.75 round, then the $2.10 round. Those are arbitrary numbers, but I think you get the idea. They're very savvy at creating opportunities for investors to invest now, right? You need to have a why now. And it's one of the hardest things to do as a founder in a raise is actually create urgency. They've mastered the art of creating urgency through a variety of openings, closings, parallel offers. If you invest 25,000 or more, you can come into their Reg D, which has a discounted price per share. Or if you're at $1,000 or less, you're in their Reg A offer and it's slightly higher price per share. So providing incentives, right? Reasons for people to not only invest now, but to invest more now. And they've been doing it for 2.5 years. And I think that's one of the other takeaways is that the companies that historically have raised this kind of capital, it takes time. They've made significant investments in the industry, not just with us, lots of partners, lots of marketing firms, lots of team members internally to deliver this incredible outcome. They are committed to the industry, and the industry has rewarded them. So that staying power is meaningful as an issuer. You cannot go out and expect to raise a lot of money in 30 days. You generally can't do it in 60 days. You have to have a long-term lens in order to raise real dollars in this space.
Creating immediacy, stimulating higher transactional value, leaning into it, bringing in more marketing partners, bringing in a great team, scaling, and over 100 million. Numbers speak for themselves.
It's wild. And I think one of the things that I like most about their story is they, like Elio, started with a base of reservation holders. They did not start from scratch. So they had this base of reservation holders, people that had put down $100 deposit to buy shares. $100 deposit to get a vehicle if and when they go into production and deliver vehicles. That same reservation holder, when given the opportunity to invests 50 times more, buying $5,000 worth of shares. So the investment is 50 times more compelling, you could say, right? Technically, if the reservations were 300, 500, you'd probably see those as well. But it just shows you the power of letting the customer become an owner. It's one thing to say I'm a customer. It's one thing to say I have this ticket in line as a reservation holder. It's another thing to say I own shares of this business. I'm an owner. I'm an investor. It absolutely carries more weight. And that's why I love talking about the average investment being $5,000. It's on the high end in the Reg A industry, especially. Usually you see $1,100, $1,500, $2,000. It's not bad at all. $5,000 is a lot, but it shows you the commitment of their community.
Yeah, you could have a fifth of the investors and raise the same amount of the capital. You can have these pre-launch funnels, getting reservations for the product, test the waters at times, a smaller percentage of reservations pushing through, but being able to have a stronger first day, a stronger first week, a stronger first month, and using that foundation to have a much more impactful trajectory through the campaign itself.
They're crushing it. They're a great client.
It's awesome. Well, Darren, this has been so insightful for me, and I work in this industry, and I'm on these campaigns day in, day out. I took a full page of notes, going to be sharing with my team. For anyone who's tuned in and would like to get in contact with Issuance or just learn more in general, where is the best place for them to go? And any final thoughts you want to leave the audience with today?
Stick with it. For founders especially, entrepreneurship is a daily battle of self-belief. You just have to continue to believe in yourself day after day, week after week, year after year, and play the long game in order to achieve success. So keep going. Follow me on X at Darren Marble. And if you want to learn more about Issuance, you're interested in raising capital, issuance.com. You want to watch seasons 1 and 2 of Going Public, you can go to goingpublic.com. And then season 3 of Going Public will stream on X and premieres on May 6th, about 75 days out.
May 6th, it's going into the calendar, and highly encourage everybody to take Darren up on that offer and get in touch with Issuance and check out all of the content. Echo all of the comments on entrepreneurship there as well. Darren, thank you so much for making the time to hop on the podcast here. Really enjoyed it.
Thanks, Jason. Appreciate you.
Awesome. Thanks again, everyone. We'll see you next time. Take care.
Yeah.